Good evening, and welcome to our coverage of developing conditions in the global silver market. Tonight is Sunday, March 8, 2026, and precious metals analysts and market observers are closely monitoring a set of converging factors that are expected to influence silver trading as Eastern markets prepare to open for the week. At the center of tonight's report is the Western futures closing price of $84.33 per ounce, recorded on Friday at the close of Western trading sessions. That price has remained static on financial terminals globally throughout the weekend, as major Western exchanges, including the COMEX, have been closed. The broader market context includes several intersecting developments. Ongoing disruption at the Strait of Hormuz has been cited by analysts as a significant factor affecting global commodity sentiment. A logistics freeze centered on Dubai has been described as contributing to what observers are calling a supply chain disruption of considerable scale. Oil is currently sitting at $86 per barrel, a level that analysts say is pricing in elevated energy market stress. These factors, taken together, have generated substantial discussion among market participants about the potential direction of silver prices when Eastern exchanges open tonight and when Western markets resume trading on Monday morning. However, analysts tracking institutional market behavior are cautioning that the path forward for silver prices over the next 12 hours is unlikely to be straightforward. While some market commentators have characterized the current setup as a clear upside scenario, others with knowledge of institutional trading behavior are pointing to the likelihood of significant price volatility in both directions before any sustained directional move is established. Central to that caution is the reported condition of major hedge funds that have maintained short positions in silver across a prolonged period, with those positions now reported to be facing severe pressure as the price has risen from earlier levels. Those institutions are described as facing substantial margin call obligations when New York markets open on Monday morning. The tension between that institutional short pressure and the physical demand dynamics currently being reported from Eastern markets is expected to produce a trading environment characterized by sharp and potentially rapid price swings in both directions. The COMEX registered silver inventory, last reported at 83 million ounces as of Friday's close, remains a closely watched figure given its relationship to the volume of outstanding paper futures contracts. We turn now to a detailed examination of the two distinct market scenarios that analysts say are currently in play as Eastern trading sessions come online tonight. Understanding both pathways and the forces driving each is essential context for interpreting whatever price action develops in the hours ahead. The first scenario, which analysts are describing as the Eastern demand surge pathway, centers on the possibility that institutional buyers across Asia and the Middle East, specifically referencing Chinese institutions operating through the Shanghai Gold Exchange, Indian market participants, and Middle Eastern sovereign wealth funds, enter tonight's market with aggressive physical silver purchase orders. The motivation attributed to these buyers is a combination of the ongoing Strait of Hormuz disruption, the Dubai logistics freeze, and oil sitting at $86 per barrel. Analysts argue that at that oil price level, inflation expectations across Asian economies rise sharply, increasing the appeal of silver as a hedge. Critically, the buyers described in this scenario are not characterized as seeking paper futures exposure. They are described as seeking to secure physical tonnage, meaning actual deliverable metal. The significance of that distinction becomes clear when set against the current COMEX registered inventory figure of 83 million ounces. Analysts note that 83 million ounces, while nominally a large number, is extremely limited in the context of global industrial silver demand. To illustrate the point, the report notes that if Chinese institutional buyers were to purchase 10 million ounces in a single trading session, a volume described as entirely within their financial capability, that single transaction would consume approximately 12% of the entire available registered COMEX inventory. That dynamic, analysts argue, is what creates the conditions for a short squeeze of significant magnitude. The mechanics of that squeeze are described as follows. If Eastern buying pushes the price upward from the Friday close of $84.33 to a range of $87 or $88, hedge funds carrying large short positions would begin receiving margin calls within hours. Algorithmic systems would begin automatically covering those short positions, generating additional upward price pressure. Call options positioned at the $90 strike level would move into the money, requiring market makers to purchase additional silver to hedge their own exposure, a process that itself adds further buying pressure. Each layer of that sequence feeds the next, creating what analysts describe as a liquidity cascade moving upward. Under this scenario, the report suggests silver could reach $95 by Tuesday morning. The second scenario represents the opposing pathway, and analysts emphasize it carries equal probability of occurring. This is the institutional spoofing attack scenario, and its mechanics are described in precise detail. The moment the futures market opens tonight, institutional actors facing catastrophic losses on their short positions are described as likely to flood the sell side of the futures order book with a massive volume of paper contracts. Figures cited include contracts representing 50 million, 70 million, or potentially 100 million ounces of silver. The critical detail, analysts stress, is that these contracts would not be backed by physical metal. They would not represent the hedging of a mining operation or the liquidation of actual inventory. They would represent the deliberate creation of artificial paper supply for the sole purpose of driving the price downward. This practice is identified in the report as spoofing, and it is described as illegal under the Dodd-Frank financial reform legislation. The report cites 3 documented historical instances of this practice in precious metals markets. In 2010, J.P. Morgan Chase was fined by the Commodity Futures Trading Commission for executing this exact type of operation in the silver market. In 2020, Deutsche Bank settled a spoofing lawsuit for $130 million. In 2024, HSBC was cited for spoofing activity in the gold futures market during what the report describes as the September liquidity crisis. The report argues that on each of those occasions, the motivation was identical to what institutional short sellers face tonight: the prospect of losses large enough to threaten the survival of the position, creating an incentive to accept regulatory fines as the cost of executing a price suppression operation. The projected effect of such an attack on tonight's market is described in sequential terms. Algorithmic trading systems, upon detecting a large wall of sell orders entering the order book, would interpret the data as bearish sentiment and begin selling. High-frequency trading systems would amplify the move. Stop-loss orders set by retail participants at visible price levels would begin triggering as the price moves from $84 downward through $83, $82, and $81. Retail traders observing the declining price would add selling pressure. The report suggests this cascade could carry the price back to $80, or potentially as low as $78 if the selling pressure is particularly aggressive. The following morning's financial news coverage, the report argues, would attribute the decline to profit-taking, technical correction, or demand destruction, framing that would obscure the institutional mechanics behind the move. The report is explicit that both of these scenarios are fully possible tonight, and that the outcome is not predetermined. What analysts describe as the most likely actual result is a combination of both: sharp upward moves followed by sharp downward moves, producing a price chart that reflects the collision of Eastern physical demand and Western institutional defense operations playing out simultaneously within a single trading session. We turn now to the structural supply and demand conditions in the global silver market that analysts say form the underlying foundation beneath tonight's price volatility. These figures, drawn from reported 2025 market data, provide context for understanding why institutional behavior on both sides of tonight's market is as aggressive as analysts are describing. Global silver production in 2025, combining mining output and recycling, totaled 830 million ounces. Global silver demand across the same period reached 1.1 billion ounces, encompassing industrial consumption, investment demand, and jewelry demand. The resulting supply deficit for 2025 stands at 270 million ounces. Analysts tracking this figure note that a deficit of that magnitude cannot be absorbed indefinitely, and that the gap between production and consumption has been drawing down above-ground inventories across multiple storage systems simultaneously. The specific inventory figures cited in the report illustrate the extent of that drawdown. COMEX registered silver stands at 83 million ounces. Reported LBMA inventory in London stands at 250 million ounces, though the report notes that a substantial portion of that figure represents allocated metal, silver already owned by specific parties and therefore not available for open market purchase. The SLV Exchange Traded Fund, identified as the largest silver ETF in the world, has seen outflows of 40 million ounces over the past 6 months, attributed to institutional investors rotating out of paper silver instruments and into direct physical holdings. The combined picture across these inventory systems is one of progressive depletion, with the report noting that if the 270 million ounce annual deficit continues into 2026, the only mechanism available to rebalance supply and demand is a price increase substantial enough to either suppress demand or draw dormant supply back into the market. On the supply response question, analysts point to a structural constraint that distinguishes silver from many other commodities. The timeline required to bring a new silver mine from initial exploration through to active production is reported at 7 to 10 years. That process encompasses geological exploration, drilling programs, feasibility studies, environmental permitting, infrastructure construction, workforce hiring, and negotiations with local governments and regulatory bodies. The consequence of that timeline is that even a sustained period of elevated silver prices produces no meaningful increase in mine supply for years. The report notes that at a current silver price of $84 per ounce, against a reported marginal production cost of $35 to $40 per ounce, miners are generating substantial margins. Yet production volumes are not rising because the physical and regulatory constraints on new mine development cannot be accelerated by price incentives alone. Turning to the macroeconomic context, the report situates tonight's silver market dynamics within a broader analysis of the United States dollar, the Treasury bond market, and the global monetary system. The United States national debt is reported at $36 trillion. The projected federal deficit for the current fiscal year stands at $2.3 trillion. Interest payments on the national debt are described as consuming 22% of total federal tax revenue. Against that fiscal backdrop, the Treasury is described as issuing new bonds at a record pace to fund ongoing government operations. The demand side of the Treasury market is described as having deteriorated significantly. China is reported to have halted purchases of United States Treasury bonds in 2023. Japan began selling Treasury holdings in 2024 to generate dollars for yen defense operations. Saudi Arabia is described as diversifying its reserve holdings away from treasuries and toward gold and yuan-denominated assets. The report states that the Federal Reserve has been absorbing treasury issuance through direct purchases, a process characterized as debt monetization that the report equates with currency debasement and inflation generation. The report describes this dynamic as a feedback loop in which each round of money creation erodes confidence in the dollar, accelerating rotation into physical assets, which in turn increases inflationary pressure, requiring further money creation. The constraints facing the Federal Reserve in responding to the current situation are described in terms of a policy trap. Raising interest rates to levels that would meaningfully suppress inflation, the report references the 1980 precedent of rates reaching 20% under Federal Reserve Chairman Paul Volcker, is described as no longer viable given the scale of the national debt. At current debt levels of $36 trillion, interest rate increases of that magnitude would cause interest payments to consume the entirety of the federal budget, precipitating a sovereign debt default. Conversely, reducing interest rates is described as risking an acceleration of inflation. Continuing debt monetization is described as destroying the currency. Halting debt monetization is described as collapsing the economy. The report characterizes the Federal Reserve as having no viable exit from this set of constraints. The report draws a direct comparison between current conditions and those prevailing in 1980, when silver rose from $6 to $50 per ounce in under 2 years, against a backdrop of double-digit inflation, an energy crisis, geopolitical instability in the Middle East, and declining confidence in the dollar. The critical distinction the report identifies between that period and the present is the Federal Reserve's current inability to replicate the Volcker response due to the debt constraint described above. The report argues this distinction has direct implications for the sustainability of any price suppression effort in the silver market. The Strait of Hormuz is described in the report in terms of its systemic importance to the global oil trade. 17 million barrels of oil transit the strait each day, representing 20% of total global oil supply. Shipping companies are described as rerouting vessels around Africa, adding 2 weeks to delivery timelines and approximately $10 million in additional cost per voyage. Maritime insurance premiums for tankers transiting the strait are described as having tripled over the preceding 2 weeks. The report describes the current geopolitical situation as producing a paralysis in policy response. Military intervention is described as risking regional escalation. Diplomatic engagement with Iran is described as threatening the Saudi alliance, and inaction is described as carrying the risk of oil prices reaching $100 per barrel, which would reignite inflation and force the Federal Reserve to consider rate increases with the consequences described above. The report also references the development of alternative trade settlement frameworks among BRICS nations, Brazil, Russia, India, China, and South Africa, describing active bilateral oil trade denominated in yuan, rupees, and reals rather than dollars. The report characterizes silver and gold as functioning as anchor assets of the emerging parallel financial system being constructed by these nations, citing physical metals' finite supply and resistance to centralized debasement as the properties driving that institutional preference. The report further addresses the repo market, described as the overnight interbank lending market through which banks fund daily operations using treasury bonds as collateral. In September of 2024, the report states that the repo market experienced a freeze, in which banks declined to accept Treasury bonds as collateral due to concerns about counterparty default risk. The Federal Reserve responded by injecting $400 billion in emergency liquidity to prevent systemic collapse. The report states that the conditions underlying that episode have worsened since 2024, given the increase in national debt, the acceleration of deficit spending, and the continued deterioration of foreign demand for Treasury bonds. Before presenting the complete summary of key data points from tonight's report, we turn to an aspect of market participation that analysts say is frequently underestimated in its importance: the psychological dimension of trading behavior during periods of extreme price volatility, and the way in which institutional actors are described as deliberately exploiting that dimension. The report argues that Wall Street institutions are fully aware that retail market participants tend to make emotionally driven decisions under conditions of rapid price movement. Specifically, retail traders are described as prone to chasing rising prices, panic selling into declining prices, and placing stop-loss orders at predictable and visible price levels. The report states that institutional actors deliberately engineer volatility through the spoofing mechanisms described earlier, precisely because triggering those emotional responses generates predictable retail selling that institutional buyers can then absorb at reduced prices. The creation of a sharp downward price move, the report argues, is not evidence that market fundamentals have changed. It is a deliberate psychological operation designed to separate retail participants from their positions before a subsequent price recovery. The report draws a sharp distinction between the paper futures price displayed on a financial terminal and the physical reality of silver supply and demand. The paper price is described as a psychological instrument that can be temporarily manipulated through the contract dumping mechanisms previously outlined. The physical reality, encompassing the Strait of Hormuz disruption, the Dubai logistics freeze, the $86 oil price, the 83 million ounce COMEX registered inventory, the 270 million ounce annual supply deficit, and the sustained purchasing activity of Eastern institutional buyers, is described as entirely unaffected by movements in the paper price. Industrial consumers of silver, including solar panel manufacturers in China and smelting operations in India, are described as continuing to place physical purchase orders, regardless of what algorithmic systems are doing to the futures price in any given hour. The report presents this distinction as the central framework through which retail investors are advised to interpret whatever price action develops tonight. If the price rises sharply, the report characterizes that outcome as evidence that Eastern institutional buyers have entered the market aggressively, and that the short squeeze mechanism has begun accelerating. If the price falls sharply toward $80 or lower, the report characterizes that outcome not as a reflection of deteriorating fundamentals, but as the execution of the institutional spoofing attack described earlier, an event the report frames as a buying opportunity rather than a signal to exit positions. The report is explicit that physical metal held outside of the paper futures system is unaffected by paper price movements, and that the long-term value of physical silver holdings is determined by the supply and demand dynamics described throughout this broadcast, rather than by intraday futures chart movements. We close tonight with a complete summary of the key data points reported throughout this broadcast. The Western Silver Futures closing price as of Friday, March 6th, stands at $84.33 per ounce. COMEX registered silver inventory as of Friday's close is reported at 83 million ounces. Global silver production in 2025, combining mining and recycling, totaled 830 million ounces. Global silver demand in 2025 reached 1.1 billion ounces, producing an annual supply deficit of 270 million ounces. The SLV exchange-traded fund has recorded outflows of 40 million ounces over the past 6 months. LBMA reported silver inventory stands at 250 million ounces, with a substantial portion representing allocated metal not available for open market sale. Oil is currently priced at $86 per barrel. Maritime insurance premiums for vessels transiting the Strait of Hormuz have tripled over the preceding 2 weeks. Shipping companies are rerouting around Africa, adding 2 weeks to delivery timelines and approximately $10 million in additional per-voyage cost. The Dubai logistics infrastructure has implemented a freeze on precious metals shipments. The United States national debt stands at $36 trillion. The projected federal deficit for the current fiscal year is $2.3 trillion. Interest payments on the national debt are consuming 22% of total federal tax revenue. The Federal Reserve injected $400 billion in emergency repo market liquidity in September of 2024. China halted United States Treasury bond purchases in 2023. The marginal cost of silver production is reported at $35 to $40 per ounce. New silver mine development requires 7 to 10 years from initial exploration to active production. BRICS nations are conducting bilateral commodity trade in yuan, rupees, and reals outside of dollar settlement frameworks. JP Morgan Chase was fined by the Commodity Futures Trading Commission in 2010 for spoofing operations in the silver market. Deutsche Bank settled a spoofing lawsuit for $130 million in 2020. HSBC was cited for spoofing activity in the gold futures market during the September 2024 liquidity crisis. In March of 2020, silver declined from $18 to $11 within 72 hours. In August of 2011, silver fell from $48 to $26 within a single week. In 1980, silver rose from $6 to $50 per ounce in under 2 years, before declining to $8 following Federal Reserve rate increases to 20%. That is our complete report on tonight's developing silver market situation. The structural supply deficit is documented. The inventory figures are on record. The institutional dynamics on both sides of this market have been outlined in full. The geopolitical disruptions affecting physical supply chains are in effect, and the opening of Eastern trading sessions tonight will begin the process of determining how the collision between physical market reality and paper market positioning resolves itself in the hours and days ahead. We will continue to monitor all developments and bring you comprehensive coverage as this situation evolves through the trading week. For the entire broadcast team, thank you for watching, and good night.